Hello, everyone, and welcome to the weekly webinar that we produce and bring to you from Business Performance USA. And this week, we're very honored to have back our guest presenter, Roz Davis Grimes. And our webinar today is part of her Budget Essentials series. If you'd missed the first one, you can find that on our website, and we'll talk more about that later. This is part two, Budget Within a Budget. I'm your host today, Cynthia Stewart, Managing Partner for Evermore Services, your partner in building tomorrow's business today. And Roz Davis Grimes, let me tell you a little bit about Roz. She holds an MBA and is truly an expert in financial operations. She's developed and delivered financial and systems training for national and global corporations, and you'll notice that because she keeps things very clear and very understandable. She's particularly adept at building and managing the processes necessary to ensure proper revenue recognition and accuracy in billing forecasts. She's an expert at spend management also, and people seek her out on that topic, how to manage your spend. Roz serves as primary resource for accounting interpretations, profit and loss, and balance sheet interpretations to ensure consistent application of accounting principles and financial policies. Roz has helped companies, numerous companies in fact, realize millions in financial and accounting operations, which is quite a feat. And she worked recently with a very large call operation. They employed over 5,000 people, so it's quite large, and she helped them realize 60 million. So you're listening to the expert who helps and keep it simple. We want to make sure this hour is worth your time. And so we want to have you ask any questions you'd like using the chat feature, and I'll be monitoring that. And also write this down. If you have a question about any specific situation in your workplace, whether it be something from the presentation today or really pretty much anything, just send an email to Victor at businessperformanceusa.org. He's our interim executive director. And watch for Roz's white paper on this very topic that also will come to you on our website. So, with that, I want to pass it over to you, Roz. I'm going to actually change presenters and share it with you, and you're good to go. Well, we have a first question. I guess, Roz, we'll go ahead and set that up. Um, Maybe you wanted to do some introduction. You might be on mute, Roz, because we're not hearing you.
Cynthia, are you able to hear me now?
Yes, we hear you now. Very good.
Wonderful, wonderful. And you mentioned that there was a question already?
There's a poll question, I think, that
Yes,
popped up on
yes.
the screen.
Great. Okay. Well, I just want to say welcome back to the budget series. We're Budget Essentials. We're happy to have you back with us today. And today we're going to talk about budgets within a budget. And last time we talked about the master budget. We talked about operating budgets and things of that nature. And I want to get a little bit more in depth now on, for example, incurred costs and cost centers. So I have a polling question out there, and you guys can respond to the poll. Do you manage a cost center, or if you don't manage a cost center now, do you plan to manage a cost center at some point during your career? And we'll open up the polls.
Okay, folks, go ahead and just submit your question real quick. I see that we've got many that have voted, and we're almost done. Okay, Roz, there we go. What we find is that the majority of the participants manage cost centers. So this is your audience today. That's great. About 75% of them, yeah. Yeah.
Wonderful, wonderful. And there's probably some of them out there that manages revenue centers as well, I see. multiple cost centers as well as multiple revenue centers. Awesome. So this may be of real interest to you as we talk about getting a better understanding of some of the cost center components, and we'll talk about appreciating cost center allocations, especially if you are one that's allocating costs. And we'll also talk about those of you who are receiving allocations to your cost center as well, and the benefits of that. We're going to look at how to develop fully loaded rates and why they are important. All right, so let's get started. Understanding the incurred cost process. When we talk about incurred costs, we look at some of the components such as headcount, how many people required to actually perform the operation within your cost center, employee expenses. We look at the salaries, bonus incentives, employee benefits like health, dental, life insurance, maybe some recruiting costs, relocation expenses, everything related to employee expenses. We also look at some contractor and consulting expenses if you use those, other operating expenses, and what are some other operating expenses you should include in your incurred cost budget? Let's hear what you have to say. Use the chat window. What are some of the expenses that you incur? Office supplies, that's a good one. You may also want to include fees and subscriptions to magazines or to various industries. Okay, marketing operation, that's a good one. Absolutely. How about telecom expenses, travel, building expenses? Yeah, pretty much everything we talked about in our last session as part of the operating budget. And also, you want to include allocations, and it's really important that you include the allocations. We're going to talk about that in depth a little bit more later on in the presentation, but to get a full, accurate cost of what it costs to operate your cost center, allocations are crucial, especially if you're working within a large organization. And then we're going to talk about accruals. Accrual is a good component of incurred costs. And accrual is nothing more than an expense that you've already incurred within a period, but you don't have an invoice for it. And it's an accounting term. And the benefit to that is, like I said, you want to make sure that you keep your records as accurate as possible. You know, it's basically the benefit that you have received, but you haven't paid for it yet. And so that's what accrual costs. And in some cases, there may be reversal of accruals. You want to put that accrual in the period that it occurred, but the actual invoice may not come till later. So you reverse the accrual the following month so that when that invoice comes in the following month, it will offset that expense. All right, we want to give you a couple of examples of budgets within a budget. And we're talking about a headcount budget. So let's say, for example, you are the manager of the order processing department. And within your department, you average about 1,000 orders per month that you guys process, and you have 30-minute average handling time, or AHT, per order. So it takes you about half an hour to handle those orders. So how many full-time employees do you need to handle the order volume? And most people, when they think about a head count, and even if they're just kind of doing a little rough in their head, they basically say, okay, I've got 1,000 orders I need to process. It's 12 months, so we've got about 12,000 orders. And it's going to take about half an hour to do it. And if you do the math, we see that it's going to require about 6,000 work hours to actually process all those orders. But where we see a lot of times is that people consider your productivity factor at 100%. So they think that productive hours are right at 6,000, which is the same as your work hours. And the difference between that is that when you assume 100% productivity, you're assuming that your people are going to be processing for 8 straight hours, no breaks, no vacation, no holidays. So that's why you'll end up having more overtime than you planned because you haven't really taken into consideration the productivity factor. And of course, if we did our annual working hours of 2080 and dividing that into the 6,000, we see that roughly we would need about 3 heads to process the 12,000 orders. So given that same example, if you look at it and you back out those paid time off or non-productive hours, which would be things like I said, vacation time, holidays, if you're people factoring in 15-minute breaks in the morning, 15-minute breaks in the afternoon, just whatever non-productive time. It could be sick time, it could be training time, coaching time. All those hours that are being paid that are non-productive, you would want to back out of the total working hours. So in this example, we ended up with an 84% productivity factor. So if we took the 84% divided by the 6,000 hours of working time, we would get our productive hours and see that, in essence, we really need about 6,973 hours in order to process those 12,000, considering the non-productive time. And when you take the 17,094 hours divided by your productive hours of 6,973, you really see that you need an additional person. So you would need 4 people versus 3 people. Any questions on that?
Actually, we do have a question. It's why do you call training and sick time and things like that? Why do you call that non-productive time?
The reason I call it non-productive time is because it's actual time that you're paying for that they are not processing orders, if that makes sense. So
Okay,
you're going to
so
pay them, you have to pay them, but they're not productive on those times
okay,
of processing.
okay. Thanks, Ross.
Sure. All right, here's another example, a travel budget. And basically, when you're doing your travel budget, you want to determine how many trips you're going to take for the year. You have an average cost per trip that you usually would identify. You want to look at the ATP, or the average ticket price for the airfare. And when you look at your average ticket price, you want to kind of separate those. You want to look at your domestic ATP and your international ATP. Any idea why we would want to do separate average ticket prices when we budget for domestic versus international? The expenses vary, absolutely. And generally, the expenses are much greater for international travel versus domestic travel. And the prices for airfare are significantly different. Then we also want to identify what your average room rate, or ARR, for your hotel, and it's also considered average daily rate. They will use those change interchangeably. How many nights are you going to stay? And what type of transportation will you use? And when we talk about transportation expenses, what are some of the transportation expenses that we would want to include in our travel budget? Use your chat window. Okay, it could be rental car, It could be a taxi service or limo service. Rentals versus transport service, excellent. Also, your gasoline, if you're renting a car, you would have to refuel the gas in the car. Yeah, those are some great example. Buses, right? How about rail, if you're over in Europe? Yeah, so those are some of the things that you would want to include in your transportation allowance as well. And you want to establish a per diem allowance for meals, okay? And all of this, of course, is contingent upon your company's policies, right? Because if they have standard policies, for example, if you have a per diem allowance for meals, then you would want to use that per diem allowance based on your company's policies. And if you do not have those established, you would want to designate what they are so that you don't have people out there spending more money than they need to be spending. Great. Um,
And we do have
and
one.
then any other travel.
Sorry, Roz. I was going to say that we have another question.
Okay.
What do we do? If you use your Visa card and then you've got fees on that, does that fit in the travel category?
Yes, that would also fit in the travel category as well. And that would be considered our next category, other travel expenses. And not only for your Visa card, if you have transfer transaction fees based on currencies, but just a visa to work in another country, that would be considered an other travel expense as well. So I have a question for you guys, and I want to use, because most of the webinars that I do, they're very interactive. So I would like to hear from you, what is your company's per diem? Can you share that with us? Okay, $100, $150 per day. Okay, and would that be considered your meal per diem or your total day per diem? For meals. Okay, great. Awesome. Very good. Very good. Other travel expenses that could be included in there too could be entertainment. If you're entertaining customers or whatever, that's also considered part of the travel budget as well. So here's an example that we have. And let's say for our department, we're going to take about 25 trips. And we're going to take about 20 domestic trips and 5 international trips. And remember, we talked about making sure that we had an average ticket price, or ATP, for our domestic air and for our international air. So we have that broken out, and then we have our daily rate. So here are the list of assumptions that we're going to use in this example, and we want to calculate our average trip cost. And when we look at the average trip cost, we can see based on the 20 trips for domestic what our airfare would be, what our airfare would be for the 5 international trips, so on and so forth. And so we come to an average cost per trip of roughly $2,100 for our domestic trip and $6,100 roughly for our international trips. And if we did a combination of both of those, we'll see where our average cost per trip is right at $2,900. So in this example, you can see why it's very important to use a domestic and international assumptions when you're building your travel budget. So let's say, for example, you budgeted 20 domestic trips for the full year, and let's say in the first quarter you had 5 trips, and each one of those trips were, say, $2,500 each. So now you're over your budget for your domestic trip for roughly $2,000 or whatever. So that means you would have to cut back one of your domestic trips later on within the year that you won't be able to make, or perhaps you may not be able to make one of your international trips or something to that effect. So it's really good when you break it down, so as you're analyzing your spend throughout the year, you can go back, see what you've budgeted, compared it to what you've actually spent, and modify your budget accordingly. Does that make sense?
That makes sense, Roz.
All right, let's talk about cost allocation. Cost allocation, primarily you'll see a lot of G&A expenses allocated back to cost centers, particularly in the case of IT. It could be allocation costs based on your copier, your fax machine, your desk phone, your network expenses, so all of those get allocated back to the cost center. And it's really a good thing that that happens because, again, you understand what your true operation cost is to operate your cost center. Some of you may have dedicated HR resources, and that cost gets allocated back to your cost center. Your finance and accounting team, facilities. Facilities, they may have a per unit cost based on cubicle versus office, or they may just do it on a square foot basis. And then your general management, your VP and director's costs, some of that allocation might get back to you because they're spreading their costs based on the number of cost centers that they have as well. And the allocations, they can be based on head count, based on the number of people within your cost center. Again, we talked about the square footage, that facilities might use that as a source to allocate costs. It could be transactional or per device. So, you may have telecom expenses for cellular phones. And they may do it based on the device or even actual cost. So allocations will come back to your cost center. And one thing that you would need to understand, if you are one of those G&A cost centers that are allocating costs back to other operation cost centers, you want to make sure that you are not over-absorbed, which means that you're allocating more cost than you should be. And as a cost center, particularly of those operations and profit centers, you want to make sure that they're not actually charging you more or allocating more cost than they should. Okay, and I see a question in the chat window. What about senior executive prerequisites? And can you type in a little bit more information on what you mean by that? What about senior? Okay. All right. So we're talking about perks. Okay. And for executive prerequisites, as it's being called, that will be a part of the general management budget. And so as we go through developing the fully loaded rates, I think you may see the answer to your question for that, and we'll touch base with that and see once we go through that if we answer that question. But to answer it, if it's included in the operation budget and the cost center budget, for general management, that will be part of the cost that gets allocated out as well. So let's go ahead and talk about the fully loaded labor rates. So let's go back to our example. You're the order processing manager, and you're setting your budget, and you're trying to develop what your fully loaded labor rate is and your fully loaded hourly rate for your entire cost center. So we talked about we needed 4 people to do the processing, 4 full-time equivalents, or FTEs, to process the orders. So if we look at our head count here, we have the order processing manager, a senior level order processor, 2 order level processors, and instead of having 3 junior order level, getting tongue tied here, order processors, we actually decided we were going to hire 2 interns to help us out, and they would be working on a part-time basis. So when we look at our base salary, we see our base salary for all of the headcount is right at $213,200, and our hours are going to vary, and we're looking at 1794 productive hours, although we will be paying them for the full 2080 hours. Our interns are slightly different. We're going to assume they're only going to work half days. And because of the way the quarter runs, generally a lot of orders come in during the 3rd month of the quarter, so we're going to factor in a little bit of overtime, about 10% overtime, and we see what our hourly rates are and our overtime rates. So what we do is we add all of that into our factors, and we find out what our annual salary is going to be. So considering all of that, oh, by the way, we did factor in a 3.5% raise, okay? Want to keep them happy. So we find out that our annual salary has gone from $213,000 up to $230,670. And then we have our cost of benefits, and let's just say our cost of benefits is right at about 25%. So we're going to include that factor, and then the incentive or the perks, as we talked about it, or what we called it the executive prerequisites, I think. This is where you would include that in the incentive. So for this particular department, we're providing a 10% incentive, and that, of course, would be performance-based as well. So for your executive prerequisites, you can also lump it into that category as well. And so we come up with our final compensation for the full year. So instead of looking at $213,200 as an initial base salary, our really fully loaded labor cost for this cost center is $294,370. So did that answer your question on where the executive prerequisites or perks would go?
We got an affirmative on that, Roz. Is that pretty typical that you would have
Fantastic.
so much from, like, you would go 213, this was a question, 213 all the way up? Is that overhead rate pretty typical?
It would all depend on your industry. It would all depend on what your executives have identified in that. But yes, it could very well, it could very well go up to 30, 40, even 50% over the base salary. Good question.
Yeah, thanks, Roz.
Okay, so now this kind of gives us a view of our base salary and increase, and we're looking for the entire cost center, and we're looking at what our straight time labor rate would be. We've also looking at what our overtime labor rate would be, and our average labor rate combined. So again, when you start looking at breaking down these different labor rates, you'll know if you have to ask your people to work an additional 20 hours overtime, you'll better understand what impact that will have to your cost center budget and to your cost center. And when we look at our total budget, where we're taking into consideration our full-year compensation, our operating costs, and our allocated costs, and we come up with our total budget, we can see that our burden labor rate now jumps up to $30.62, and you can kind of see what your average cost per hour for your operating and allocation costs would be, and you would determine what your fully loaded hourly rate should be to for your processing department. And you said, why is that important? It's important for you to know that because if anyone, let's say your boss, he's working with the executive team and they're looking at bringing in a new account. And within that account, you've determined you're going to have maybe like a 20% uptake in order volume. Well, now you can actually see how much more budget you would need in order to let your boss know we can do that and it will cost this amount. So that's why it's important. So if we look at the fully burdened cost, at the bottom here, we can see that our hourly rate for our full-time equivalent employees is right at $66.45, and for our interns, it pretty much stays the same because we're not providing any benefits to them. And so your average rate for the entire budget is now a fully burdened rate of $55.32.
So, Roz, are
Do
you
you have any
saying,
questions?
yeah, there is a question. Are you saying that if you add another person, you would just multiply whatever hours they would spend by that $55 rate to get kind of an estimate of the impact to your budget?
Right. If you were going to add one additional person to the budget, you would multiply your 2080 full-time hours times the $55.32 to see what the total impact to your budget would be.
Thanks, Roz.
Sure. Great question. You guys got good questions today. Awesome. Okay. So that's what I wanted to share with you guys today. And just kind of going back over what we've covered today, we talked about the cost center components. And of the cost center components, these are pretty typical. Your head count, your employee expenses, your contractor expenses, other operating expenses to run the cost center. We talked about allocations, how they're basically costs allocated from primarily G&A, and it could be other allocations within the organization as well, but some of the common ones you'll see would be IT, HR, finance, facilities, things of that nature. And we talked about the difference between the productivity factor, factoring those in at 100%, versus factoring the non-productive or paid time, reducing those from your total 2080 working hours to come up with your productivity factor. And, we talked a little bit about the travel, like how to develop your travel budget, how you want to be very distinct in building a domestic travel budget and an international travel budget. So I think, given that, Cynthia, I'll turn it back over to you.
Okay. We do have a few more time, a little bit more time for a few more questions. So let me give you just a minute. If you have any questions for Roz, this is a great time for you to type them into your chat box. course, we're looking for questions that are answered specifically in this arena, the expense budgets. So, do you have any expense budget questions? So, we have one coming up. Roz, this is a good question. How often during the year do you recommend that you review your budgets?
I believe you need to review your budget monthly. As soon as you get your actuals, you should compare them to your budget and then develop what we call a forecast by replacing the actual incurred expense into incurred costs into your budget model so that you can recalculate, if you will, or forecast the impact of what the actuals for the current month had on your entire budget. So I would keep your standard budget as planned and then develop a forecast as you review those actuals that are incurred each month and overlay them with what your budget was for that existing month. So monthly.
Good, Roz. Thank you. There's another question we have here. How early prior to the end of the year should you start budget planning for the following fiscal year?
Excellent question. Excellent question. I believe the budget process should start about the beginning of August of the prior year in which you're going to budget, especially if you're getting input from other members within the organization. It allows that time to review. It allows them to provide input. And in many, many, many organizations, you're going to have 3 or 4 different iterations of the budget. So especially if we're doing a top-down budget where the executive team has provided you with a magic number and they have to roll up to the magic number for the organization, there's generally going to be 4 or 5 iterations of the budget depending on whether or not that number is being met. So that's a really good question. So I would say start in August and expect budget revisions and changes from that point up until November, and we'll get the budget is usually loaded into your financial systems prior to the end of the year in December so that you can get rocking and rolling in January.
And that's when your fiscal year and the regular year, calendar year, match up, right?
That is correct. That is correct.
Okay.
Otherwise, if the fiscal year is not the same as a calendar year, I would recommend 5 months prior to your fiscal year
Okay,
ending.
good. Good.
Mm-hmm.
So 5 months. Another question. Should budget planning for the following year be used prior to the end of the current year to resize or right size?
Okay, could you repeat the question for me again?
Yeah, sure. So, should budget planning for the following year, so you're looking really to the future, be
Mm-hmm.
used prior to the end of the current year to change the current year's budget?
Yes, the answer would be yes. If you are planning on right sizing your organization in the current year, that cost benefit in the current year you would definitely want to roll over into the following year as well. So that again, that's one of those revisions that you would make in the different iterations of the budget going forward when you're planning for the following year. Good
And
question.
what we've got another one related to that, Roz, and it's let's say that you are resizing your organization. So let's say that you're downsizing, in fact, your organization, and there will be people working in the current year that won't work in the new year. What happens to those dollars that used to be in the budget and they're not there?
Okay. And I'm going to kind of give you Roz's view of this and how and what I've experienced. Okay? If you have your budget And let's say you're in September, and let's say you have 3 positions you haven't filled, but you have headcount in your budget for those 3 positions. Okay? And you're developing your budget for the following year. So you want to include those headcounts going forward for the next year, right? Right. If I'm your finance person and I see that you've operated without those 3 people for 3/4 of this year, I am not likely to recommend an approval for those new 3 people unless there's a change in the business that would require those 3 people. I may drop it down to 2. I may recommend 1. But if I know that given the business that there's going to be an uptake in business and we can validate having those 3 additional headcounts, I would recommend those to be approved. Otherwise, if I don't see where we're going to have a significant uptake in the business, I would not recommend those 3 people be added as headcount and resources and budget for the following year. Now, given that, I would say if I was a cost center owner, I would put it in there. I would rather let you tell me no than, especially if I see something, if I see something in my operation where I need those 3 people, but it's not likely to get approved.
Boy, I like getting the 2 different viewpoints.
Sorry.
Well, I've seen all of that as well, and that's the way it works. But we do know that there is change in business. New special projects come along, or somehow you do get an in uptick in customer requests, customer orders, and so it's not unusual for managers to want to make sure that they've got adequate staffing to meet all of those needs. But excellent response to that question. Okay, we really have a few more minutes if there are any other questions at all. Um, in light of the question we just had, which is, business varies across the year. And so you do have a plan, and yet things don't always get spent at the time you thought that you were going to spend them, or you don't get the revenues at the time. So, what do you do about meeting all those upswings and downswings and other competitive challenges?
That's an excellent question. Excuse me. In the event that you see, for example, that your budget, um, you anticipated spending, um, having additional head count for your budget, and you don't really have the work there to justify the head count, there are ways that you can cut back on your budget. And I've seen this done. It's been recommended over and over. Let's say within your order processing department, you see where orders have dropped, and let's say you have 500 orders a month instead of 1,000, and well, you really don't need 4 people to process 500 orders for the month, right? So you can do a couple of creative things. You can offer unpaid time off. If someone wanted to go and travel, for 2 weeks and come back, you can offer unpaid time off. That will help balance your budget. You may want to cut back on your travel. You won't need to travel as much, so if you cut back on a couple of trips, you may end up saving $5,000 to offset that. On the other hand, the reverse of that, let's say you have 1,500 orders a month versus 1,000, and you need an additional head. You may want to hire a contractor to offset the additional productivity that you need. So there's a number of ways that you can balance your budget and still keep that head count the same.
Well, we have another question. Let me take this slowly, Roz.
Okay.
What about keeping the budget current while reducing work hours 75% in order to retain valuable business learning in the company? So basically, you're taking and reducing hours
Okay. So you're reducing hours
by 25%.
by 25%. Okay.
And we,
To
we,
increase retained earnings. Okay.
well, let's say that business isn't at the level that you expected,
Okay.
and so you're not able to pay the full salary rates.
Mhm.
And yet you want to keep the knowledge of the people that work with you in your
Sure.
business. You want to keep
Sure.
it. You don't necessarily want to lose anyone. Is
Right.
it common practice to maybe just cut the the number of hours worked and the salary in order to retain that knowledge and keep even with the current revenues?
That is an option. Absolutely, that is an option. In doing so, you also have to keep in mind if you are reducing hours and your employees are pretty much dependent on that pay, that you may lose them, right?
Right.
So one of the things that I've been engaged is that some companies are offering what they call mandatory vacation. So it's a little bit different in the cost savings arena. Is that you're going to pay these people for vacation time, but at this point, you see a lot of it where some companies they'll close the week of Thanksgiving, or they'll close the week of Christmas, or something to that effect. So it does save money in the sense that you're mandating that they take that vacation time to close the building, save on electricity, air conditioning, and the whole 9 yards. When you're shutting the building down where nobody's able to work, there's a significant cost savings in that alone. So that's another approach that you might want to look at as well.
Yeah, and I think that the key in these kind of situations is to be very transparent about why you're doing these things.
Absolutely.
Maybe even give the employees some different options so they feel like they've got a little choice in the matter. You want to do these things and make sure that you don't lose your employee base and cause morale issues. And you can do
Exactly.
that if you just keep the employees in the loop on exactly what's happening. And
Right.
they maybe can come up with other suggestions and ideas and about how they can save money and also how they may be able to bring more money in. So keeping them in
Exactly.
the discussion, I think, is really important.
And that's a great point, Cynthia, because if you really look at it, the employees they want to do what's best for the company, and 9 times out of 10, most of them have stock in the company as well. So if they want a great return as well on their stock, right? So if you're rolling out something and you show the benefit to the organization that, hey, if we shut down for the week of Thanksgiving, we'll save $5 million. You know, who wouldn't want to make that contribution to the company and reap the benefit on the return, right?
Right, right. And when people are treated well, they're always willing to make those kinds of decisions. And in some cases, what could be, a quarter of your salary off for the month, not that easy. But if you can give people lead time and so forth,
Exactly.
they'll cooperate and help you. They'll really help you. I think about Southwest Airlines, who has had to make some tough decisions, engage their workforce, and their workforce really came through. So well, we're at about almost top of the hour right now, if I can get that out. And Roz, this has been a very informative and very clear. webinar today, and we appreciate you for your work on this. And we will welcome you back next month to talk
My
about,
pleasure.
yeah, to talk about when to use capital expenditures. So thanks very much, Roz. And we invite our audience, our listening audience, to come back each week. Next week, I'll actually be speaking on something called The Line of Significance. And this is in my Critical Numbers series, also called Vital Signs. Talked about vital signs last month. And this month, it's how to really align your employees to understand the key measurements in the system and how they can help move the company forward. So it's getting everybody aligned and pulling in the same direction. And I'm calling that the line of significance. It's how people can significantly contribute to the organization. And then after that, we'll have Victor coming back on his brand series, Time Measures the Brand. We've had some great webinars from Victor, and then comes Dr. Jeff with his Kiss or Kick, and we're all wanting to know about that Kiss or Kick. So his Exemplary Know-How series. We welcome you back next week, and thank you very much for attending today. This webinar was recorded and will be on the website within the week. Thanks so much, everyone. Bye-bye.